Finally, the time we've all been waiting for, the S&P 500 almost 2 years later hits all-time highs and closes at 48.35. Investors over the last 2 years have weathered quite the storm from hyperinflation, Fed tightening, and even an earnings recession. Yet the biggest stock market in the world is now soaring higher than ever. But as we approach new all-time highs, we have to remember the famous words of Jay-Z. The hard part isn't getting rich, it's staying rich. And now we have to ask the question, what comes next? Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit the notification bell. Let's get into it. And what an absolute crazy day. The leaders, semiconductors, so green across the board. Everything from manufacturing equipment to chip makers themselves. Tech as a whole participated, but so too did financials, cyclicals, communication services, industrials in large part, but they were pretty green yesterday. What didn't though was consumer defensives, utilities, and basic materials. And the winner today was the Nasdaq, nearly putting up 2% in total return. And this is an entire index, the Nasdaq 100. I mean, the S&P 500 up 1.23%. Small caps participated, so too did the broader market. And bonds as a whole put up a flat day. And the S&P 500 just hit new all-time highs, guys. When I told each and every single one of you to buy here throughout most of December, I said we should look for new all-time highs, and here we are right now. Sure, I said for most of this week we're probably going to trade around the 475 level, but here we are, new all-time highs, 48.39, testing the highs made in 2021, start of 2022 of 48.18. And it's been about 500 days since the S&P 500 had its last all-time high, and this is where we are right now. The sixth longest time between all-time highs in the S&P 500, and was super bullish. We didn't just close at all-time highs, we closed 20 points above the previous high. And here are the stats. Now, for the most part, the 1 year forward returns after the S&P 500 has made a new all-time high tend to be very positive in the double digits. Excluding 2007, where we had a negative year, you can almost always expect the 1 year forward returns to be positive for an average return of about 11.2%. So very positive, all things considered. And if you have a look at this right here, months to next recession, and for the most part, I mean, excluding 1980, 1954, 1961, and 2007, we normally have extremely long periods of time before we enter a recession. We're talking like 44, 84 months, 75 months, and this could really be the start of a new bull market. Now, over the last year, the majority of gains in the S&P 500 has actually come from multiple expansion. This is because in 2024, 2025, we are expecting double digits earning growth. That's why multiples were increasing, particularly in technology, comm services, and discretionary. Now, what normally follows a year of extremely huge PE growth, in a year like this, it's normally followed by earnings. And if we can have 2024 earnings materialize this year, it's going to be a very good year for markets. And hopefully we can go on an earnings hot streak like we did here. And this from 2016 all the way to 2020, absolute rally. If you do remember that period, 2016 to 2020 was such a good year for stocks as a whole. Now let's dive further into valuation, and the S&P 500 return on equity has stabilized in 2023 following declines in 2022. So you can see the declines that happened right here, and the S&P 500's return on equity is currently sitting at 20.5%, and EBIT margin expansion has supported return on equity in 2023. Margins have actually expanded despite the current economic headwinds, which has led to a 55 basis point increase in S&P 500 margins and a return on equity of 20%. Now, looking at return on equity versus price to book, and all in all, consumer staples looks to be fairly undervalued, whereas utilities, despite its low price to book ratio, on its next 12 months return on equity actually actually seems relatively expensive. And here we have technology, infotech, return on equity looking at 35 to 40% with the price to book ratio of 9x. So just some valuation ratios to go right there. You can see that this part right here tends to be quite expensive, but anything, from here and above, this tends to be cheap, a little bit expensive, but that's where you really want to be, especially with growth consensus. Now let's actually have a look at valuations in terms of these sectors. Now the S&P 500 currently sits at 19.7 times, a PEG ratio of 1.3x. Not bad when you think about it. The cheapest sector right now is energy and financials. The most expensive is infotech on a price to earnings basis, but on a price to earnings growth ratio, it's infotechnology is the cheapest, as well as comm services, and financials in very, very close second, right behind technology. What technology does lack though is significant amounts of free cash flow yield, and this tends to be because of valuation metrics. Their prices tend to be higher, but if you actually have a look at stuff like energy, that's a 9.6% free cash flow yield compared to technology of 2.7%. But that being said, you can definitely see that all in all, technology, consumer discretionary, staples, and industrials are relatively the most expensive sectors in the S&P 500. Now looking at individual sectors and what they did as a whole today, the best performing sector was semiconductors, and I think a lot of this had to do with the earnings news that SMCI put out. They put out fantastic earnings, as well as what TSM put out in the week. A lot of people were looking at what TSM did, what SMCI did, and a few of the other smaller tech names today, and they were just on the bandwagon that maybe 15% earnings for tech this year might actually be underpriced. We could be looking at anywhere from like 20% plus, especially in semiconductors, and that's why we saw a huge rally in semiconductors, technology, and software. These three sectors completely outperformed. Regional banks though, the second best performing sector for the day. Every sector except utilities and staples were negative on the day, and I think we're finally getting our answer. The rotation we saw at the start of January, where we saw people going into healthcare, utilities, staples, that was more of a buy the 2023 losers. What we can definitely see here is that the leaders, semiconductors, technology, continually drive capital into the market. Now let's look at sentiment, and the turn of the year barometer just wrapped up, guys. So this is when November 19th to January 19th, right, is positive, greater than 3%. That is a bullish trigger. We've had 37 bullish triggers, 2 losses, 35 wins, average return 16.5% right here. And here's the returns every single month, as well as the actual barometer right here for each year. And kind of crazy when you think about it. We just had a bullish trigger in that 3-month period. We returned 7.2% after an absolutely stunning week today. A bullish turn of the year has triggered, and this likely means we probably go higher into 2024, because this is the most reliable turn of the year signal out of all of them. It beats the first 5 days of January and the Santa Claus rally in both precision and accuracy in predicting returns if you look at Z-scores as a whole. Now let's look at sentiment data at these highs, and according to the Goldman Sachs sentiment indicator, positioning has actually come down. It's not quite as stretched despite the rally we've had, and that's because if you actually go ahead and look at the S&P 500 index over the last 2 weeks, in the 9 trading days, 7 of them were actually down days, 2 of them were up days, but those 2 days made up significantly for all of these down days, and that's why we've probably seen sentiment move down, and that's why we have seen the bull bear indicator not move, because it was at 5.5 last week. So this is roughly the same, this is roughly the same, and the sentiment right now is still hold. If you're holding on to longs, hold them. If you're in shorts, well, good luck to you. Now this is what BOFA's private clients are buying. Now, BOFA's private clients had equity inflows of negative 6.81 billion for the week ending 17th of January. And this is the second week of consecutive outflows. The first 2 weeks of January were actually quite bearish, all things considered. We've only seen quite bullish momentum from about midday Wednesday onward to right now. Now, this is what FMS investors are currently overweight. You can see that they're overweight healthcare, technology, and cash. And we saw quite the rotation into healthcare at the start of the year. And I do think a lot of people are betting big on earnings growth for healthcare. They are expected to produce earnings growth of about 14 to 15% depending on who you look at. I've seen some sources say 19%, but all in all, healthcare, technology, which are the 2 biggest sectors in the S&P 500, continue to be the leaders in fund flows and portfolios, as well as cash and US equities as a whole. What people don't particularly like is UK equities, utilities, and insurance stocks. All in all, let's have a look at positioning as a whole, and this is greater positioning in the S&P S&P 500. And I do think now that we hit all-time highs, this is going to make the headlines, and trust retail investors to start buying at the highs. Hype tends to follow when we do break highs like we did here in COVID, and that's when we entered this hype train and made our way all the way up. And if this is to materialize and we do see huge amounts of inflows into equities over the next year, 2 years, we could really see the S&P 500 have a huge blow off top going past 5,300, 5,400. Let's talk about the Bitcoin fund flows. Now, these are the Bitcoin ETFs. Now, for the record, I don't actually recommend buying these. There's some very sketchy stuff in the PDSs in terms of what they hold, how they hold it, and the settlement of Bitcoin for cash for investors. That being said, we have seen total outflows from GBTC into pretty much every other ETF. We've seen about $1 billion worth of inflows into Bitcoin ETFs. And I do think as a whole, this is going to be positive for Bitcoin. Now, we got the latest GDP Now data sitting at 2.4%, and Goldman Sachs dropped this on their trade desk along with the GDP data we just got. They said that despite a modest bump in December, inflation news remains very favorable, with global core inflation averaging just 2% annualized over the last 3 months. They said the US led the way on disinflation. Labor markets and inflation expectations are also back in balance, and they expect consecutive 25 basis point cuts in March, May, June, followed by quarterly cuts from Q3 onwards of a total of 5 cuts in 2024. They expect the ECB and the BOE to closely follow in rate cuts, and their expectation of significant cuts combined with resilient activity and falling inflation supports above consensus growth views in most major economies. And what does that mean? We probably get that 10% growth in the S&P 500 that a lot of analysts are predicting. And companies are looking at rate cuts right now and loading up on debt. The US investment grade bond market is setting a record pace of issuance through the first 2 weeks of the year. This is what we do on average, and you can see we are well above the average in terms of investment grade credit issuance in 2023. Now, looking at the bond maturity wall in 2024, right here for US investment grade bonds as well as European investment grade bonds, there's not a ton of bonds that need to be refinanced for 2024, and this is why American corporates and European corporates sit in a very good position. In terms of high yield bonds, very similar situation, not a lot of debt maturing relatively speaking, but this is going to increase in 2025, 2026 for almost every sector, including US high yield and European high yield. But particularly in Europe, we're going to see a huge uptick and a peak in 2025, 2026 before the maturity wall does go down. Now, we got quite a lot of data this week, and let's break it down. So retail sales actually grew at 0.6%. Initial jobless claims fell. Industrial production and MFG output rose in December. Now, the New York Empire State Index did fall, but this is for New York manufacturing specifically. And I saw every bear quote this particular statistic. But all in all, the data that we've seen coming in has been very, very supportive for a resilient economy. Now, we got consumer sentiment data yesterday. We got Michigan consumer sentiment that ticked up to pretty much 2021 highs. We also saw that the number came in at 78.8. The consensus was 70. And if we actually have a look at United States Michigan current economic conditions, this also came in at near 2021 highs, 83.3. The forecast was 73. So very, very bullish stuff coming in terms of sentiment, economic data, and economic conditions as a whole. And sentiment is a direct reflection on disposable income. And what we're seeing right now is the effective change in disposable incomes. Almost every single income quartile continued to be on the up and up, especially on the upper end and the fourth and third quartile. But we're seeing modest gains in the bottom and second income quartiles. And this is one of the major reasons why the consumer is being so resilient in the US and throughout the world. We're seeing very much the same statistics throughout Europe, and some of this coming into the Asia Pacific region as well. Now, most of this growth has largely been attributed to inflation, but some of it has also been because of labor market tightness, and the labor market continues to be tight. But the wage growth forecast for Goldman Sachs, we do see that wage inflation is going to further fall from about where it is right now, the 4.5% level, to just above 3%. And that's sort of where the Fed wants it, between the 2 to 3% level. Along with a strong consumer, also seeing global demand pick up. And this is global chip sales for semiconductors, and actually is a good leading indicator of global demand. And we have seen global semiconductor sales wane throughout 2023. They are now on the up and up, and hopefully this trend continues significantly higher. And I do think, based on the AI trend trade it probably is. Now, a part of the reason we actually rallied this week was in part due to Taiwan Semi. And they released their earnings, it was a double beat, but what people really took away from it is because of AI, they're predicting a 20% increase in 2024 in terms of revenue growth. And they attribute all of this to the huge demand of chips that they need to produce for a ton of technology companies that are buying chips head over fist for the AI race that's incoming. And we also saw junior names like SMCI reported their earnings. I think they beat earnings by double digits. They were up like 35% during normal trading hours. And Barclays right here literally raised their price target from 335 to 396. They absolutely smashed through it. So this guy is going to have to revise his price target come Monday. But this is the type of thing we're seeing. We're seeing across the board TSMC with Nvidia. We're seeing a ton of earnings revisions to the upside for semiconductors. And this bodes really, really well for technology. Right now, we are expecting 14.7% earnings growth in earnings per share. This is mostly on 9.4% of sales per share, 5.3% in net margin. But based on what we're seeing with semiconductors, tech earnings might even come in a lot better, at least on the semiconductor side. And semiconductors are a part of this right here. And something we're also seeing is that profit margins by sectors. By 2025, 5 out of the 10 S&P 500 sectors are looking at improving the margins into 2025. I think a lot of this actually has to do with rate cuts, all things considered. But have a look at technology. Margins right now, profit margins, in between 25 to 30%. We can also see consumer discretionary, a huge increase, even though retail tends to be lower margin. We see further increases for industrials as well as communication services. Margin decreases though in healthcare, but all in all, everything else tends to be within the average. Now, a big elephant in the room is a possible supply shock. We have seen container freight costs skyrocket with the situation that's going on in the Red Sea. We'll see how this affects the markets as a whole, because I know that a lot of countries, particularly the US and Western countries, have done a lot to onshore manufacturing since 2020 pandemic. Now let's dive a bit deeper into what supply shocks look like. Now, depending on the nature of the supply shock, we normally have the very first thing that happens is the central bank has a huge response, and they either tighten or ease. And in 2024, we know exactly what the central bank is going to do. From there, the market adjusts its expectations to inflation and future economic growth. Investors might demand a higher risk premium if they expect higher inflation or dampened economic growth. And then because of that, we normally do see a flight to safety or a flight to quality in terms of stocks. So this is the roadmap that we will look at and follow when it comes to a potential supply shock in the Red Sea. Now let's have a look at January seasonals. The S&P 500 for the month of January is up 1.4%. We are actually blitzing the historical performance of January. And there was a lot of bearish sentiment right here, especially down here. And look at where we are right now. And this is why I say you should have been buying the dip right here, guys. Now we are entering into the window of weakness as we make new all-time highs. This is where we are right now, and this is just a window where dealer supportive flows aren't really there in the market, and we normally see an expansion of volatility. It doesn't mean we're going to crash. It just means that we might see more volatile trade over the next couple of weeks, and we do get these dealer supportive flows back first week of January. Now, looking at Gamma as a whole, a ton of Gamma expired on OPEX today. We can see right here, there was a ton of negative Gamma, a ton of positive Gamma, and I'll let you guys know on Monday before open what this graph actually looks like. But I guarantee you there's going to be a lot less Gamma in the tape. What we really want to look at is where this flip zone is from positive Gamma to negative Gamma and where the call resistance currently is. So I'll give you guys an update on Twitter. So go ahead and follow me on X or whatever they're calling it right now. Now, this is a look at the heat map from Friday. And we are starting to see negative Gamma pockets come into the market. But where we are trading right now is sort of right here. We went right through this negative Gamma zone, this neutral Gamma zone where positioning was quite light. And we went through this positive Gamma zone. If this positive Gamma zone holds into Monday, it's going to be a very, very strong supportive area if we do come away down in terms of holding the S&P 500, the index above the 4,800 level. Looking at the charts, and this is the week. I have some weekly charts here here for you guys. And this is a cup and handle we've been forming on the S&P 500. And you can see this is the handle. We've actually broken above this line, and we've broken above key support lines that we needed to as well, right here and right here. And as such, if you make a measured move from here to here and plant it at the lows all the way up, it takes us to 52.50 if this is to play out. Now there will be pullbacks on the way, 100%, I can guarantee you that. As it stands, this looks very, very strong. I mean, you look at this chart and it's bullish, and even more so the Nasdaq 100. It looks exactly like the S&P 500 chart. The only difference is that it looks a little bit stronger, because it normally is. It's a lot more tech names, and they have been the leaders over the last 2 years. See, here's the cup, that's the handle. We've broken above this key zone right here, and a measured move takes us to about the 19,300 area. Now the IWM is looking a lot more grim. It really needed to not just break above here, but hold this line. We have come down and we are finding support right here, but what the IWM needs to do is break above this 2,000 level and hold it. And more specifically, it needs to break above the 2,100, 2136, use as support and go ahead and attack these highs. Otherwise, we probably go and test this level right here in small caps. And if that is to happen, that's going to be not a great look, because we're going to see the leadership we are seeing right now in tech continue to thin out into 2025. So we really do want small caps and mid caps to participate in this trade. Looking at PayPal, something I wanted to bring to you guys' attention, ever since PayPal CEO went on CNBC and did his interview, there's been a lot of buzz on PayPal, and this chart is looking significantly more bullish. I would wait for the 67 level to be broken first, tested as support, because we have seen this before: break above the 200 moving day, a break above the 200 moving day, and then a rug pull. Now PayPal is reporting earnings on the 2nd of the 7th. The key thing you want to look for in their earnings is margins. If they can get margins above 17% right for the full year, that's going to be very constructive, because that means that in 2024 they can attack 18% margins, in 2025 they can attack 19%, and in 2026 they can attack 20%. And if you don't even price any growth into the stock right now, assuming terminal inflation growth, that would take net income to about $4.7 billion divided by 1 billion shares outstanding. The earnings per share would be at $4.7, and if you multiply it by a 20 PE, you get $94 as a stock price for PayPal. Now that's not including any growth, and growth is expected to be at about 9% per year. So if they get 17% margins or better for the full year 2023, that's going to be really bullish, and I think the stock is really going to rally into that, especially considering that they are expected to grow earnings at 9% over the next 4 years. They're expected to have net income of 7.7. That's at a 20% margin, by the way, divided by 1 billion shares outstanding, and they are buying back shares. You go 7.7 multiplied by 20 PE, it puts the stock at about $143. The stock right now trades on 11x, but historically it has traded at around 32x. At these prices, PayPal does look really, really good, but I would still wait for the earnings call on February the 7th, evaluate everything, and then from there you can make a well-informed decision. The stock has a long way to run if everything does go its way, and missing out on 10 or 20% right now, you're still going to get the full you're still going to reap the full results in PayPal in the future. Now looking at SMCI, this is super bullish. I think this is going to run to 500 over the next couple of weeks into its earnings results. I think SMCI, maybe we see a mild pullback on Monday, and then we just continue all the way up to 500. The price action and volume on this name is so good. I think we're going to go to 100 billion in valuation, and it's probably 19 billion right now. Now looking at Nvidia, very similar to Supermicro, we said we were seeing some ugly candles right here. It just shrugged it off, and Nvidia continues higher to the 600 price target. I do have an end of year price target of 650, but I think so does everybody else, to be honest. Now looking at Apple, this is a trade I gave to you guys. I said at the 200 moving day it's going to bounce. It did exactly that, and I had a price target of 192, and it actually hit it intraday. So there you go. Do I see further upside for Apple? Probably. I think there's a lot. I think the Vision Pro is a good headwind for Apple looking into earnings. Looking at financials continue to be super, super strong. Look at this. If we break above these levels right here, I think we're going to go ahead and test the 40-41 level for financials. This looks very, very strong, and it definitely was the strongest sector all things considered, looking at the sell-off we had, in the first couple weeks of January. Now, looking at the equal weight, it's back above the 155 area. I do want it to consolidate further above the 155 area and look to higher price action for the RSP. But the RSP hasn't made a new all-time high. This is really what I want to see. I want to see the entire S&P 500 as a whole go ahead and make new all-time highs. And it's going to take a lot of the, weaker stocks in the S&P 500 to really get moving before this goes ahead and breaks all-time high. And I think the all-time high in the RSP is about 163. So it's about 3 to 4, maybe 5% away from its all-time high. So still a bit of work to do to put in the entire market. Looking at the US dollar, something that could be really good for stocks is that we're seeing a resistance right here at the 200 moving day. Maybe the dollar does go lower. It's going to really help oil prices and stocks as a whole for earnings in 2024 if the dollar can go ahead and do that, because it's looking very strong right now. But you look at this, you made a high, lower high right here. At least we're making one, as well as lows, but we did put in a lower high in comparison to this right here. But we do have to see, maybe we can go ahead and do something like that and then move lower. Now here is some composite cycles. I showed you guys this last week. This is the 1950 to 1966 bull run, and this is the 1980 2000 bull run. And this is where we are right now, the S&P 500. And it looks like, based on the secular bull market breakouts from 1950, 1980, and 2013, suggests that the S&P 500 can spend much of 2024 above 5,000, and especially look at an endpoint between 6,500 and 7,200 in the S&P 500. And this has potential upside of 40 to 50% in the S&P 500. Looking at the actual secular market roadmap, you can see here that generally speaking, when we've had periods of consolidation, huge consolidation right here in, from 2000 to 2013, like we did in 1966 to 1980 and 1937 to 1950, when we have secular breakouts like we did right here, we normally have bull runs that last for 20 to 25 years. And if all things considered, we're probably only halfway through the current bull market, which does see the S&P 500 go ahead and reach, just below the 10,000 mark. Now, looking at data in the week ahead, guys, next week's focus will be on GDP, personal income, and spending, and particularly the GDP number as well as PCE as a whole as personal income. And this is what BOFA expects in real GDP. They think the Q4 2023 forecast is going to be 1.5 quarter over quarter, and they think a lot of that is going to come from consumer spending as well as non-residential investment and then government right here. So this is the number we're looking for, 1.5%. And then in Q3 2023, we had an actual number of 4.9%, that bullish GDP print. But all in all, GDP growth nonetheless. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit the like button and the notification bell, leave a comment. Cheers.